Hello value investors, thank you for joining me. Today I want to talk about some of the lessons that I've learned in the last several months about portfolio diversification and about position sizing. So if you haven't done so already, check out my marketplace on Seeking Alpha. It's called Deep Value Returns. If you get in touch now, I'll give you a 25% discount on my annual subscription. And I'm not just saying that, I really think that it's a very good value for money because I have a very good, vibrant community, a group of value investors to think like-minded and help each other out. Also, I give you 1 or 2 new stock picks every month, which I think, the track record kind of is not illustrative of future returns, but it gives you kind of a guidance of what to think about. Also, I just help you think about how to invest more generally. For example, if you're kind of new to investing or been investing a little while, just kind of give you a little bit of experience, bit of a rounding off. Even the best investors in the world have a network around them and some way to just think about looking at different positions from different angles and just someone to bat ideas off. So anyway, without further ado, so on the graph here, you can see that red arrow. So that red arrow I was getting hit quite badly in the last several months as the market for growth stocks particularly were really kind of taking a bit of a hit. So I have a hybrid portfolio. The hybrid portfolio means half the portfolio is in kind of traditional value names, stuff that is low growth but generates a lot of free cash flow, stable free cash flow, quite predictable, boring businesses. And I have the other half of the portfolio, newer companies that kind of growing quite fast. Overall, the companies altogether in the portfolio are generally quite small cap, typically less than 5 billion, more or less below 5 billion. So they're quite volatile as it is. But the biggest lesson that I took in the last several months is about how to average into that position. And everything is common sense and everything is great in hindsight, but this is just like a little safeguard, like when NASA puts astronauts on the moon or whatever, on Mars or whatever, like they are kind of thinking about how to prevent loss of life. So you have these kind of safeguards, these checklists or, these rules of thumb to really stop you, because ultimately investing is quite an emotional game and you need to be able to kind of have these checks and balances against yourself to really kind of just take out all that emotion out. So having something quite mechanical that you can default back to when things are kind of a bit odd, like sort of just to stop your emotions from really taking over your investments, because ultimately you're buying businesses, but it can be quite emotional and it takes a behavior, you have to really temper yourself and you always fall back to where you've initially trained. If you trained your mind to a certain level and you trained yourself in how you're going to be a stock picker, when stocks get very volatile, you come back to that default level. Hope that makes sense. So when I made a couple of very large mistakes in the last several months, I had 2 positions that really went really sour for me, and it's fine. I'm absolutely fine making mistakes. Even the best stock picker in the world is only going to be right 2 out of 3 times. That's fine. I can take that. But what I did was wrong was that I went in too aggressively and I bought too much of the stock, and it went against me. And that's fine, but I should have been a bit more kind of careful on the way, and I should have been a bit more humble. And I've designed this rule that I think helps me, may help you. I don't know, you'll see. Whenever you get into a position, so my portfolio is normally around about 14 stocks, thereabouts. I have kind of the top 5 picks, the big weight of the account for roughly 50% of my portfolio, and then I got some kind of the rest that I'm either averaging in or averaging out of. So within the top 5 picks, even if I get something that's really, really exciting, like the narrative's compelling, there's like margins, business is growing well, it has huge tailwinds, even if it's really attractive, from now on, the rule I'm going to make for myself is that no matter how interesting, no matter how appealing it is, I'm going to just put 3% on my portfolio. Now, for some investors that have a portfolio of, let's say, plus 30 stocks, it's quite a lot to put into one stock. But as I said, I have 50% of my portfolio in the top 5 picks. So 3%, is not a lot. I would normally look to get that to approximately 10% if I'm really excited about something. So if I get a 3% position, and I'm not talking, typically my holding period is about a year and a half or so. So I'm not talking about going to hold it for 10 years. So it's kind of something, I'm looking for something to happen in the next like 2 years or so. So I'm not going to be buying in and then waiting a long time. So, but I buy in today, 3%, and I follow the company, and it's amazing. No matter how well you know a company, I gave this example always of Apple. No matter how well you know the company, you can be the biggest fanboy when it comes to Apple, but you don't know enough about Apple until you become the owner of the business. Once you bought a share of Apple, you start thinking like the business owner, and things in the universe have a way of kind of coming around to you as the owner of that business. You kind of learn a little bit more once you're the owner of that business. Following the company on the sidelines is one thing, but once you're the owner of the business, you think differently. And the universe has this way of bringing more answers to things that you hadn't really thought about. So 3% when you first get attracted, and then you wait 30 days. And you put down another 3% if the story still is quite attractive. I'm not price sensitive. I'm not saying, oh, if the share rallies off, I'm not going to touch it, or if it falls down, I'm not going to touch it. I'm not that price sensitive because I'm looking for things that have such a large margin of safety that if things kind of go a bit up or down in 30 days, it's not a big deal. So I put 3%, and then 30 days later, I put another 3%. So now I've got a 6% position. And now, here's the thing. I'll wait until the next quarterly results have gone past. So this is what I thought before. This is my thesis has been validated even further, for example, and I can then put another 3 or 4% after that. So really averaging into the position over a period, hopefully, of 60 days to 90 days. Because I'm not buying the company and holding it for many, many years. It needs to be something that has some kind of visibility. Oh, the market's not quite understanding this. In 2 years, they might see the company differently, because I'm really trying to think, how is the investor 2 years from today going to be looking at my business? Will they look at it in a different lens? This is what I'm really looking for. I'm looking for the investors to have a different outlook on the business, to understand something that I can kind of maybe pick out today. I'm not always going to be right, as I said, I have about a 30 to 40% failure rate. Things go wrong, but I just kind of trying to average in a little bit more and trying to have that visibility. How investors misunderstand what is being masked that I can see, but the people aren't paying sufficient attention to. It can be a smaller unit that's growing quite fast. It could be a big unit that's kind of being fizzed out and divested. It could be something that's happening that I don't think investors quite are giving enough grasp to what's going to happen in 2 years. It could be that, for example, the business, I can see, it doesn't take a genius, that the business is growing really, really fast, and I can see that the margins are starting to expand. So it's going to, in 2 years' time, it's going to look really quite attractive, and people will be willing to pay a higher multiple for that stock. I particularly like things that are quite highly shorted, because that means a lot of people have an opinion that's negative on the business. And if I can tell a lot of people that have a negative opinion that, it turns out that they were wrong, they'll have to buy back all that stock. I'm not talking about a short squeeze. Those are quite rare. I know that it's happening right now in GameStop and some other stocks have that, but those are very infrequent. Even if a stock is highly shorted, it takes a long time for investors to come around to thinking about it. I know that there are a few names that everyone knows about, that the short squeeze of Weight Watchers or Porsche, there are a few of those, but or GameStop obviously, or maybe for the sake of the discussion, Tesla, but they're quite rare. But the point I'm trying to make is, if you're trying to go where people don't want to buy, and you're able to convince people over time, over the next 2 years, that actually they will be too gloomish on this, you get a re-rating, and the psychology of investor changes over time, and that's what you get rewarded from. So you have the intrinsic value of the business growing, and you also have the re-rating. So you have these two kind of levers going for you, and that kind of obviously is very volatile. You can see on the graph right here how volatile my portfolio is, because I'm buying small caps, I'm buying a concentrated position, I'm buying highly shorted stocks. I'm always thinking about the cash flow generation. And I hope you found this video useful, and don't forget to check me out on Seeking Alpha Deep Value Returns. I'll tell you the stocks I own and why, and if you let me know, I can give you a 25% discount. Thanks for getting in touch.